Good morning, everyone, and welcome to BP's fourth quarter and full year 2020 results presentation. I'm Craig Marshall, Senior Vice President, Investor Relations, and I'm joined today by BP's Chief Executive Officer, Bernard Looney, and our Chief Financial Officer, Murray Auchincloss. Before we begin today's presentation, let me first draw your attention to our cautionary statement. During today's presentation, we will make forward-looking statements that refer to our estimates, plans, and expectations. Actual results and outcomes could differ materially due to factors we note on this slide and in our UK and SEC filings. Please refer to our annual report, stock exchange announcement, and SEC filings for more details. These documents are available on our website. I'll now hand over to Bernard.
Thanks, Craig, and hello, and I hope everyone is managing to stay safe and well, and my best wishes go out to all of you and your families. I think it's fair to say that we are reporting on a tough quarter at the end of a tough year for everyone, a year in many ways unlike any we've ever had. The COVID pandemic has been first a human tragedy. It's taken lives and challenged our mental health. It has also impacted the global economy significantly, and we've seen the impact in our sector, where road and air travel are down significantly, as are demand for products and commodity prices. But looking forward, as we must do, I'm optimistic, particularly given the vaccines, but also because of the actions that we have taken across the company. Before we discuss that future, let me take a moment to reflect on 2020. It was a pivotal year for BP. We set a new direction, launched a net zero ambition, introduced a new strategy to transition from an international oil company to an integrated energy company, and started to execute on it on multiple fronts, including entering offshore wind in the United States. Began reinventing BP, reshaping it to support the delivery of our strategy. And through all of this, we focused on performance. Our operational teams have kept the energy flowing with fewer injuries and fewer safety incidents compared to 2019, and at levels of efficiency and reliability that are, I think, remarkable given the additional challenges. We have brought 4 major oil and gas projects online and seen the completion of a 3,500 kilometre gas supply pipeline. And we have strengthened our finances, taking out costs and closing some major divestments. This is great delivery by our team, all the more so given the year that we've just had. And as always, we have more to do. We'll update you on that today and also address some of the big questions we've been asked since our Capital Markets Day in September. In a minute, Murray will take you through our latest results and the financial frame. But first, let me recap on some of the key areas of progress. Turning firstly to our performance in 2020, starting with safety, as we always do. It's our core value, and it's at the heart of performance across BP. We had fewer Tier 1 and Tier 2 process safety events compared with 2019, and fewer people injured at work. An achievement we are proud of, but there is always more to do. And it is not just about having fewer incidents, but also supporting the welfare of our people, particularly at such a difficult time. Later this quarter, we will release our 2020 sustainability report, and we expect to report a decrease in our Scope 1 and 2 greenhouse gas emissions. We also expect a reduction in the estimated Scope 3 greenhouse gas emissions from the carbon in our upstream production, reflecting our strategy to high-grade and focus our hydrocarbons business. Turning to our financial performance. For the full year, we delivered a $5.7 billion underlying replacement cost loss, with underlying operating cash flow of $13.8 billion. The result reflects lower oil and gas prices, significant non-cash exploration write-offs taken in the second quarter, resulting from a review of our long-term strategic plans, and lower refining margins and depressed demand due to the pandemic. During the year, we took a series of decisive actions to strengthen our finances and create a strong foundation from which to advance our strategy. In April, we outlined measures to support our cash flow, resulting in a 28% reduction in total capital expenditure and a 12% reduction in cash costs. In June, we revised our long-term price assumptions. Later that month, we issued our first hybrid bond. We received 6.6 billion of divestment and other proceeds during the year. And as part of our new financial frame, we introduced a new distribution policy, including a reset dividend. As a result of these actions, at the end of the year, our net debt reduced to 38.9 billion, and we remain confident in reducing this further to our target of $35 billion. And Murray will talk about this more shortly. Turning now to our operational and strategic delivery, where we continue to focus on performing while transforming. I'd like to draw out a few examples that I think really highlight the progress we have made, starting with resilient and focused hydrocarbons, where we delivered 4 major projects in the year. Since 2016, we have brought 28 major projects online, delivered on average, on schedule, and under budget. On Raven, wells are online, and we are in the live commissioning phase. Once ramped up, major project capacity is expected to approach 900,000 barrels of oil equivalent a day, with 4 more projects scheduled to start up in 2021. On the 31st of December, first gas flowed from the Shah Deniz field in the Caspian Sea through the Southern Gas Corridor pipeline to customers in Europe. This project was delivered ahead of schedule and 25% under budget, an enormous achievement for one of the most complex energy projects in the world. Responding to the environment in the upstream, we delivered 20% lower capital spending than in 2019, with a continued focus on capital efficiency. An example is our Mad Dog 2 project, where we completed 6 wells using 218 fewer rig days and delivered just over $280 million of savings compared to the sanction case. On Mad Dog Phase 2, sail away of the Argos FPU from the Samsung yard in Korea is imminent, an important milestone for a key project. And with all pre-first oil wells drilled, this further underpins our confidence in delivery. We have also taken steps to focus and high-grade our portfolio that create value for BP, completing the divestment of our Alaska and petrochemicals businesses, both of which did not compete for capital inside our portfolio. Taking the decision to convert our Kwinana refinery in Australia to an import terminal as we focus our portfolio on top quartile assets. And just yesterday, we announced a divestment of a 20% stake in Oman's Block 61 for a total consideration of $2.6 billion, while retaining a 40% interest and operatorship. In convenience and mobility, we continue to make strategic progress, unlocking access to a key growth market with Jio-bp, our Indian mobility joint venture with Reliance, growing the number of EV charging points to over 10,000, now with more than 1,400 in China through our joint venture with Didi, adding around 300 strategic convenience retail sites, and increasing our convenience gross margin by 6%. In low carbon, effective last week, we completed the formation of a strategic partnership with Equinor to pursue offshore wind opportunities in the United States. The partnership initially intends to develop 4.4 gigawatts gross of offshore wind power across 4 projects, and we've already made great progress. Last month, 2 projects were selected to provide New York State with power earlier than expected, and subject to contract means 3 of 4 projects will have secured offtake. Lightsource BP continues to grow. It developed 1.4 gigawatts gross to final investment decision, or FID, in the year. It also added around 6 gigawatts gross to its pipeline. And elsewhere, we are pursuing opportunities to partner with corporates, cities, and industries looking to decarbonize. We have announced partnerships with Microsoft and Amazon, and with the cities of Aberdeen and Houston. And last week, we announced our first decarbonization strategic partnership in the aviation sector with Qantas. Together, we will seek to reduce carbon emissions and contribute to the development of a sustainable aviation fuel industry in Australia. These examples highlight the real value we place on partnerships. Building strong and enduring relationships with partners around the world is part of our heritage and integral to the success of our strategy. By working together with partners who bring complementary skills, we can accelerate our low-carbon transition. Let me now hand over to Murray to take you through our results and financial frame.
Thanks, Bernard. Good morning, everyone. Turning first to the environment in 2020, without a doubt, a challenging year. Oil demand fell by around 9 million barrels a day. Production cuts from OPEC Plus helped slow the buildup of inventories and cushion crude oil prices, which averaged $42 in 2020, 35% lower than 2019. Refining margins were extremely weak, with BP's RMM averaging $6.70 in the year, compared with $13.20 in 2019. Gas demand fell by an estimated 2.5% globally in 2020. All regional gas prices dropped, notably in the second quarter when JKM and NBP prices fell close to Henry Hub levels, discouraging U.S. LNG exports. Looking ahead, the oil price has risen steadily since the end of October, supported by vaccine rollout programs and continued supply management by OPEC+. We expect prices to remain supported by active supply management and improving demand as we see the expected benefits of the vaccination rollout and further virus control measures. In gas, tightening LNG markets at the end of the year have supported a strong recovery of NBP and JKM prices. U.S. gas markets are likely to benefit from lower production and a recovery in the international LNG demand driven by Asia. And in refining, with a projected demand recovery and several third-party refinery closure announcements, we see a gradual improvement in the refining margin in 2021 once the stock overhang is absorbed by the market. Moving then to BP's underlying results. In the fourth quarter, we reported an underlying replacement cost profit of $100 million. Compared to the third quarter, downstream performance was significantly impacted by lower marketing performance, with volumes remaining under pressure due to COVID and the continuing pressure on refining margins and utilization. In addition, the result was impacted by a significantly weaker result in gas marketing and trading and higher exploration write-offs, partially offset by a higher Rosneft contribution and a lower underlying tax charge. The fourth quarter dividend, payable in the first quarter, remains unchanged at 5.25 cents per ordinary share. Turning to cash flow and the balance sheet. Excluding oil spill related outgoings, underlying operating cash flow for the fourth quarter was $2.4 billion. Compared to the third quarter, this reflected the significant impact of lower marketing volumes in the downstream and a significantly weaker contribution from gas marketing and trading. The absence of the working capital release in the third quarter and other working capital effects. The absence of the Rosneft dividend and severance payments for Reinvent BP, partially offset by lower tax payments. Organic capital expenditure was $2.9 billion in the fourth quarter and $12 billion for the year, at the lower end of our targeted range. Supported by divestment proceeds, including $3.5 billion from the sale of our chemicals business to INEOS, net debt fell by $1.4 billion in the fourth quarter. At the end of 2020, net debt was $38.9 billion, benefiting from the issuance of $11.9 billion in hybrid capital in June. This represents substantial progress from $51.4 billion at the end of the first quarter and brings us closer to our targeted $35 billion. With that summary of 2020, I now want to focus on what comes next. As laid out last year, we have a new financial frame with 3 firm principles, a clear set of priorities and business plan. Together, this is expected to drive strong growth, improve returns, and a sustainable reallocation of our capital employed towards the energy transition. You should be very clear about what to expect from us. In 2021, we plan to pay a resilient dividend, deleverage towards our $35 billion net debt target, drive further cash cost efficiencies through our Reinvent BP program, invest in a disciplined manner to advance our strategic objectives, including increased investment into the energy transition, and deliver on our commitment to commence share buybacks once our net debt target is reached and subject to maintaining a strong investment-grade credit rating. Let me talk into each of these elements in more detail. Starting with our disciplined approach to expenditure. We have a disciplined approach to capital allocation across all our businesses, testing for strategic fit, affordability within a rigorous capital frame, and quality against stringent hurdle rates. In 2021, we expect capital expenditure to be around $13 billion, including inorganics. We have flexibility within this frame should the environment deteriorate. We plan to invest around $2 billion in low carbon, around $2 billion in convenience and mobility, and around $9 billion into our oil, gas, and refining operations. We are also driving efficiency in our cost base. As Bernard mentioned, 2020 cash costs were down around 12% relative to 2019. And there's further to go as BP's Reinvent program and associated cost reductions gain momentum. Total headcount was reduced by around 11% in 2020 as a result of the Reinvent program, net divestments, and other efficiencies. Of the expected headcount reduction of approximately 10,000 associated with the Reinvent program, more than half have already left BP and the remainder will depart during 2021 and early 2022. We expect a total provision of around $1.4 billion associated with the Reinvent program and expect the majority of the cash outflow to be incurred during the first half of 2021. Delivery of this program supports our confidence in delivering on our cash cost reduction targets. We now expect to achieve a pre-tax savings run rate of $2.5 billion relative to 2019 during 2021, ahead of our prior guidance of end 2021. And we continue to expect $3 to $4 billion pre-tax cost savings from Reinvent by 2023 relative to 2019. I now want to update you on our plans to reduce net debt and how this underpins our approach to committed distributions. During 2021, we expect to continue to reduce our net debt. Divestments and other proceeds will be an important contributor. With yesterday's announcement of a 20% divestment of Oman's Block 61, we have now completed or announced transactions totaling over half our target of $25 billion of proceeds by 2025, and we expect to deliver between $4 to $6 billion of proceeds in 2021, of which around $4 billion have already been announced or completed. We expect the realization of proceeds to be weighted towards the second half of the year. Turning to net debt, we continue to expect to reach our $35 billion net debt target sometime around 4Q 2021 and 1Q 2022. This assumes oil prices in the range of 45 to 50 a barrel and BP planning assumptions for RMM and gas prices. In the first half of the year, we expect net debt to increase as operating cash flow is expected to recover from the fourth quarter, benefiting from stronger oil prices, slightly higher production, and a recovery in trading performance. However, we expect a heavier weighting of cash outflows in the first half of the year as we incur the majority of the severance payments associated with the Reinvent program, make our annual GOM oil spill payment, and make the final payment relating to our U.S. offshore wind JV with Equinor. In the second half of the year, net debt is then expected to fall, supported by the absence of first half specific outflows already noted, a further improvement in operating cash flow supported by upstream delivery, easing of COVID impacts on downstream performance, and further cost savings from Reinvent, and with the receipt of the second half weighted divestment proceeds. As a reminder, on reaching $35 billion net debt, this will trigger our commitment to commence buybacks from at least 60% of surplus cash flow, subject to maintaining a strong investment-grade credit rating. This creates direct exposure to the delivery of our business plan and higher commodity prices. Subject to the board's decision each quarter, we intend to maintain a fixed dividend of 5.25 cents per ordinary share per quarter, our first call on funds. Together with our buyback commitment, this means that in aggregate, across 2021 to 2025, we expect to deliver per share distributions equivalent to over 10 cents per quarter at around $55 Brent and BP planning assumptions, with upside to higher prices. Taken together, these measures underpin our financial frame and business plan. This slide summarizes the progress that we've made toward our key points of guidance and targets. You should think of this as our annual financial scorecard and part of our commitment to transparency. Further detail on our guidance for 2021, including the first quarter, can be found in today's SEA and are summarized in the appendix to this presentation. And finally, that scorecard will be underpinned by a significant evolution in our external disclosures. As of January 1st, 2021, our new organizational structure became effective, and we start reporting on this basis with 1Q 2021 results. This matrix reminds you of where our businesses sit within the new reporting structure and how they map to our strategic focus areas. In early March, we plan to release restated financial and operational data for the new business, including 2 years of historical data, together with supporting materials to help you understand our new disclosure framework. Disclosures will include certain elements below the business group level to help model and benchmark our business. The disclosures will help you track our strategic progress, and we believe will enhance the understanding of and provide transparency around how to model and value our business. Now, let me hand you back to Bernard.
Thank you, Murray. I'm now going to spend a bit of time addressing some of the questions we've received following our Capital Markets Day in September last year. In doing so, I'm going to focus on each of our 3 strategic themes in turn, highlighting some of the key messages we provided, outlining the progress we've made during 2020, and explaining what you can expect from us in 2021. I want to start with resilient and focused hydrocarbons, the cash engine of BP. A distinctive part of the strategy we have outlined is our intention to shrink our oil and gas production and refining footprint over this decade. This is expected to help us deliver absolute emissions reductions, reallocate capital, and focus on value. But some of you have expressed concern about what this means for our ability to deliver the cash flow the group needs to transform. So I want to be very clear. We expect to grow EBITDA to 2025, both headline and underlying, from a high-graded, higher margin and smaller portfolio. So why should you have confidence in this statement? Well, the answer lies in 3 things. Number 1, a 20% expansion in oil and gas unit margin. Number 2, delivery of cost synergies. And number 3, a high-graded refining portfolio. Starting with the 20% margin expansion, we expect to deliver this through project delivery, investment decisions, operational improvements, and portfolio choices. Taking each in turn, we continue to deliver from high-margin major projects. 28 major projects are currently online, with the 29th, Raven, in the live commissioning phase. During 21, we expect a further 4 startups and to ramp up Ghazeer and Raven, underpinning confidence in reaching the 900,000 barrels of oil equivalent a day from major projects. And with Mad Dog Phase 2, Tangguh expansion, and Cassia compression planned to start in 2022, we expect to sustain that level of production until at least 2025. We plan to drive value through our investment decisions as we focus on near-field opportunities and optimize a deep and low-cost resource base. Within this resource base, there are 20 years of investment choices identified at an average development cost of just $9 a barrel. This compares to a 2020 unit DD&A rate of over $14 a barrel. Simply put, we can do more with less, driving capital productivity as we concentrate on near-field opportunities and manage our business towards a lower, more efficient R/P ratio of around 8 years. We plan to drive value through improved plant reliability with a goal of reaching 96% by 2025. And finally, we intend to divest lower margin assets which don't compete for capital within our focused investment frame. We're not in a rush, and we'll do this when we can secure the right value. The result will be a more focused, higher margin portfolio. By 2025, we expect 8 core positions to account for over 80% of production and EBITDA. Moving to number 2, cost synergies. We're changing the way we work. We're becoming more centralized, more digitally enabled, and more agile, lowering costs and speeding up cycle times. We are on track to deliver 1.5 billion of savings from Reinvent from our hydrocarbon business by 2023, around half from oil and gas operations and the remaining from our refining portfolio. and we are already close to our production cost target of $6 a barrel, a level we aim to maintain. Finally, number 3, refining. We already have a concentrated, high-quality portfolio operating with high levels of availability, but there is more we can do. We intend to high-grade the portfolio, drive synergies from our new operating model, and continue to pursue an unrelenting focus on operational excellence. Taken together, these actions support our plan to move our portfolio to top quartile net cash margin by 2025. This will strengthen our resilience and increase leverage to an expected improvement in the refining environment over the medium term and as the world emerges from the COVID pandemic. I hope this helps you see why we have confidence in this plan. Turning next to convenience and mobility. With a continued focus on the customer, this business is an important contributor to our growth and returns objectives. By 2030, we aim to nearly double the $5 billion of EBITDA delivered in 2019, while generating ROACE of between 15 and 20%. Some have asked why we believe we can do this, especially given the transition in the energy system and uncertainty around oil product demand. Here is how I think about that question. First, we are building on a strong foundation. This is a business with scale and a track record of growth. We realized around $5 billion of EBITDA in 2019, around 7% per annum EBITDA growth between 2014 and 2019. Resilience. 2020 was a tough environment with around $900 million of COVID-19 impacts. Despite this, we achieved a record year in our convenience business, growing gross margin by 6%. We expect COVID impacts to reverse over time as restrictions are lifted. And looking ahead, we see further opportunities to build resilience as we digitize the business to drive efficiency and grow margin. And excellent returns. We have consistently generated ROACE of 20% or more. Second, our strategic focus areas offer real growth potential. We plan to scale up our differentiated offers in growth markets, redefine convenience in key focus markets, and scale up next-generation mobility solutions, including electrification, sustainable fuels, and hydrogen. We are confident about this because we have businesses which are adaptable and can thrive in the energy transition and leverage our quality brands, partnerships, global scale, and deep know-how. Third, we've made good progress in the last 12 months, more than doubling the number of retail sites in growth markets, growing the number of strategic convenience sites to more than 1,900, delivering a record $1.3 billion of convenience gross margin, and increasing the number of electric charge points to more than 10,000. Taken together, this gives us confidence in our growth plans to 2025 and beyond. Looking to 2021, you should expect another strong year of strategic progress. We will continue to expand in growth markets, rolling out Jio-bp branded stations in India with 5,500 stations expected in this market by 2025. We plan to increase investment in our Castrol brand, drive growth and value, and further expand our 28,000 strong network of branded independent workshops. We expect to grow our margin from convenience and electrification, supported by a planned further expansion of around 10% in our network of strategic convenience sites and the continued rollout of ultra-fast charge points across our retail sites in the UK and Germany. And we will evolve and personalize our customers' experience by further enhancing our digital and loyalty offers. Finally, as Murray mentioned, we plan to provide enhanced disclosures in early March. This will allow you to better understand why we think these businesses are so valuable. Moving finally to low carbon electricity and energy. We are very clear about where we can add value here, and we have 4 focus areas: low carbon electricity, integrated gas, bioenergy, and hydrogen and CCUS. Since unveiling our strategy, you've raised some questions about low carbon electricity. In particular, whether we can meet both our volume and our returns objectives. So today I'm going to focus on three questions that we've heard. The chart here shows BP's projects, pipeline, and hopper on a net basis. So question one, will we really put value over volume? The answer is emphatically yes. Capital discipline is central to our growth agenda. We are clear that value creation will come from the quality of the opportunities that we mature through our hopper into our development pipeline. And we will only pursue opportunities that we believe can generate disciplined project returns of at least 8 to 10%. Let me give you an example. In the second half of 2020, our teams evaluated an option to acquire a pipeline of solar assets in the United States. This opportunity had real scale and could have significantly added to our existing pipeline. But despite making it to the final few bidders, we withdrew because the purchase price did not underpin our returns expectations. In the fourth quarter alone, we took the decision not to advance over 12 gigawatts of opportunities. Question two, are there projects available that meet our returns hurdles? Absolutely. At the end of 2020, we had developed a total of 3.3 gigawatts net. This includes projects in our strategic joint venture, Lightsource BP, which has developed around 30 projects to FID with weighted average expected returns in the range of 8 to 10%. And with our US offshore wind joint venture, we reached a major milestone with the announcement of the power offtake agreements. These significantly de-risk the projects, reducing cycle time and creating certainty over future revenues early in the investment cycle. This means we are even more optimistic about the value opportunity than when we entered the agreement in September. Question three, can you find enough projects to meet your volume objective? We're making great progress. On top of the 3.3 gigawatts I've just described, we have a strong pipeline of around 11 gigawatts of options being developed. We have projects in our pipeline across 9 countries. Our developed assets plus pipeline grew by around 90% in 2020, and we have a hopper of a further 20 gigawatts of active opportunities under evaluation. In addition, the formation of our strategic partnership with Equinor has completed and I believe has a great future, leveraging the capability and experience of both companies. As I said earlier, the partnership intends to develop 4.4 gigawatts gross of offshore wind power from 4 initial projects in the United States. In January, 2 projects were selected to provide 2.5 gigawatts of power to the state of New York. This means that alongside an 800 megawatt agreement already in place and subject to negotiation of a purchase and sale agreement, we will have secured offtake for 3.3 gigawatts across 3 projects, significantly de-risking the investment opportunity. Beyond the initial 4 projects, the partnership expects to participate in future developments in the United States. Turning to solar, Dev Sanyal calls Lightsource BP an execution powerhouse, and I agree. This partnership brings together the global reach of BP and the project development experience of Lightsource. In the last 3 years, Lightsource BP has expanded its global presence from 5 to 14 countries and grown its pipeline from 1.6 to 17 gigawatts. And in the last 3 months alone, it has developed almost 400 megawatts to FID across 4 projects in the US and UK, and has just completed construction on Project Impact in Texas, bringing 260 megawatts to the US market through a long-term trading contract with our trading and shipping division, a great example of integration. As well as this, in just the last 2 weeks, Lightsource BP has acquired a 1 gigawatt pipeline from RIC Energy and signed a deal with Verizon to build a 152 megawatt Bellflower solar project in Indiana, which will add to our active projects and pipeline mentioned earlier. Many of you have asked for tangible examples. Here's one. Based in the Zaragoza province, Vendimia is a cluster of 5 solar plants and is Lightsource BP's first major project in Spain. The project was developed to FID at the end of 2019 and is currently under construction. It is expected to come online in a few months evidence of the execution capability and the speed at which Lightsource BP can complete solar projects. Once online, it is expected to bring 247 megawatts of renewable generating capacity to the region, providing clean energy to around 50,000 homes. As you would expect, the project uses efficient structured financing. But what is really exciting is the 7-year PPA locked in with our trading and shipping business, a great example of how we are using the power of integration to optimize returns across the value chain. And Lightsource BP intends to continue its growth in Spain through the recently announced acquisition of a 1 gigawatt development pipeline from which it hopes to mature projects towards FID in the near future. In summary, I hope that by highlighting our discipline when approaching new projects, alongside the momentum in solar and offshore wind, I've given you confidence in our ability to grow our renewables business while maintaining disciplined returns. Let me then briefly sum up before we take your questions. This has certainly been a challenging quarter at the end of a difficult year, but today's presentation also shows just how far we have come in reinventing BP. We are focused on executing our plan step by step, day by day, all while focusing on performing while transforming. Through extraordinary circumstances, we have delivered safe and reliable operations, strong operational delivery, and comprehensive progress on our strategy and our plan to reinvent the company. We recognize that we are a transitioning company, one of many across the economy and one of several in our sector. We have the ambition to become a net zero company, but our transition will not happen overnight. We are not yet green, but we are greening, and we are committed, not just because it is the right thing to do for the world, but because it is a tremendous business opportunity, and we believe one that will deliver long-term shareholder value. Thank you, everyone.